Hey guys, Daniel here with Value Investing with Daniel. Thank you for tuning into this video. In this video, we're going to be discussing the simple compounding strategy that great investors like Terry Smith advocate for, and Warren Buffett has moved really towards over the last, let's say, 20, 30 years of his investing career. And I'm going to break it down. It's a simple three-step strategy, and what it involves is investing in great companies and holding them essentially, forever. And the good thing about this strategy is, the focus is really on being able to evaluate the great companies to buy them by not overpaying for them and then doing nothing, literally never selling them under any circumstances whatsoever, basically. So this was really broken down by Terry Smith, and he's a great British investor, and he has a book out, and you can always read it. So look him up, Terry Smith. This is three-step strategy. It's nice and simple, straightforward, but it does require some diligence in applying. So let's break it down. Step one is to buy great companies. So great companies can be defined as companies that have high and growing returns on capital, high growing free cash flows, um, high and growing revenues, and very little debt, and have simple products and services that will be relevant, let's say, in 15 years. Typically, these services are consumer defensive type services or products, things that people will buy sort of and aren't super costly for people to buy, that have some sort of brand image as well that people like. An example of a company like this would be something like Procter and Gamble, Coca-Cola. So any company that basically has simple products and services, has very little debt in terms of the company, growing revenues, growing free cash flow, and high and growing returns on capital. When we can find these great companies, and typically, these would companies that meet just these criteria would probably be less than 5% or even less than 1% of the companies in the investing universe. So if we have 10,000 companies to invest in, I'd be surprised if more than, let's say, 100 meet this criteria. So we're trying to buy great companies with simple products and services, basically. Now, the second rule in this formula, or the second step, is don't overpay. And to calculate if we're overpaying or not is very simple and straightforward. We look at the average sustainable free cash flows of the company over the last, let's say, 3 years. We average them out and we use that as our free cash flow yield. And we want that yield to be at least 1.5 times greater than the AAA bond yield. So if the current AAA bond yield is 5%, we'll want our free cash flows, not just the most recent year's free cash flows, the average, let's say 3 years or something along those lines, free cash flows to be 1.5 times the AAA bond yield. So if the AAA bond yield's 5%, we'll want like something like a 7.5% average sustainable free cash flow yield from our companies, basically. And that is the simplest way to look at if we're overpaying or not. So, in the current climate with AAA bond yields, something like, about 4.5 to 5%, we're going to be looking for companies that are yielding us somewhere along the lines of at least 7% in terms of its average sustainable free cash flow yield. Now, in terms of the final step, which is basically do nothing, that literally is do nothing. So once we buy these great companies with simple products and services, remember these great companies have very little debt, growing revenues, growing free cash flows, high and consistent and growing returns on capital. We don't overpay for them. So just the great companies will only be like, let's say out of a universe of 10,000 stocks or something along those lines. We're looking at maybe 100 that meet those criteria. So something like 1%. And then of those, we want to buy them, but we don't want to overpay. So we limit ourselves to the companies, those great companies that are trading at less than 1.5 times the AAA bond yield, um, at least 1.5 times the AAA bond yield. So like I say, current AAA bond yield somewhere around 4.5% or 5% or something along those lines. So we're looking for companies currently with a AAA bond yield of, let's say, the average 3 years, average last 3 to 5 years worth of free cash flows, that yield being about 7% or greater. So that's in the current climate. If we had looked like, let's say, 2 years previously, where AAA bond yields were basically nothing, we would be content with a 3% free cash flow yield from our companies, or 4%, for example. But how low you go in terms of that free cash flow yield will also depend a little bit on the growth rate. Obviously, if we're looking at companies that are just 1.5 times the AAA bond yield, in that case, we're going to be looking for companies that are able to grow really fast. But now remember, once we buy these companies, we're doing nothing. We're never selling. We're pretending that the sell button does not exist unless we need the money. So we plan to never sell these companies basically ever. So once we buy them, we're not selling under any circumstances, basically. We're literally going to hold them until we die, or even, beyond that. So the idea is to buy these great companies, don't overpay for them though, and then do nothing. Just hold them forever, basically. And you'll get your dividend payments over the rest of your life, basically, from them. They'll appreciate, they'll continue to grow and dominate their industries if they're great companies that are able to do these things. And if they have simple products and services, they definitely should not go obsolete. So those are some things to keep in mind. Remember, this is a three-step formula, very simple. You're looking for great companies, don't overpay, and then do nothing. Hold them forever, and no, don't sell them basically under any circumstances. So that's a simple strategy. That's a three-step compounders strategy that people like Terry Smith from Fundsmith in the UK advocate, and that's sort of their position and what they do. I hope this video was informative. Be sure to like the video, be sure to subscribe, turn on the notifications, and if you have any questions, you can leave them down in the comment section down below. Thanks, I hope you enjoyed the video.